Okay, folks, we are going to be covering a few things in this webinar today. A few of them are, we're going to talk about the monthly range and the information that we can glean from that and how useful it is, as well as the weekly range, the daily range, which is what you guys most hear me speak about in my videos and posts on my threads. We're going to revisit the Asian range. We're going to talk about the average daily range today. And we're going to talk about orders, stops, and targets. And we're going to give a little bit more insight on determining your daily trading bias so you can practice in the sandbox in your demo accounts. Alright, we're going to talk about the monthly range first. Okay, and I'm going to bore you a lot with a few slides of just meandering about just the general principles and revisit some topics, because there's a lot of folks that are following us that are new and they've just discovered us on Baby Pips, and that's cool. I'm really happy to hear about it. I get a lot of emails in the last 3 weeks. I think I've picked up another 150 different folks around the world that frequent Baby Pips, and I'm very honored that you guys are interested in my work. And hopefully this will be one more installment to that library that you've gone on to like. But we're going to determine the current market structure. Okay, it begins with the monthly range. Okay, and we're going to talk about this in greater detail when we have the chart section towards the latter portion of this presentation. But right now, we're just going to go over the salient points. It's going to be a lot of boring material. I apologize, but it's necessary because it's going to be in recorded format. You guys can go back to this as a resource. When you're currently breaking down the market from a top-down perspective, you want to start with a monthly range. Okay, where are we at in terms of the monthly range? In other words, where have we been trading from in terms of resistance and or support? And you need to understand where we are in terms of those highs and lows, because that'll be a catalyst to you being profitable or unprofitable, because it's going to give you very low odds if you trade against that premise. And you'll see more when we go into greater detail with chart examples. But you want to be focused on the swings and the turning points that are found using the higher time frame. And the highest time frame we can really use is the monthly range. So you hear me teach swing points and swing highs and lows. And a lot of times, if you have copies of my old Pro Traders Club videos, you'll actually see me using the MT4 fractal indicator, which is really just a little highlighter, okay, to show you where a swing high or low is based on Bill Williams' definition of a swing high and low, which would require a high with two lower highs on both sides. Okay, that would be a classification for a fractal high. I don't require that. I just simply look for a three bar pattern, and we'll cover that also when we get to the chart section. But when you see these swing points on the monthly chart, they have a very huge impact in terms of where price is most likely going to go. Obviously, we want to note the monthly range key support resistance levels. Okay, not only are we looking at the upper boundary resistance level of the range, we're looking at the lower boundary support, but there's also key levels within those outer boundaries that we have to be aware of. And we're going to use fibs to discuss that. We're going to talk about natural support and resistance, and we're going to look at implied support and resistance as well. Okay, you want to be trading in the direction of the primary, and the primary is going to be found by using the monthly, weekly, and daily. Okay, that's the premise for a successful top-down analysis. If you stick to just trading in that realm, your trading is not going to be a whole lot of in and out, real quick, fancy dancing scalping. Okay, that's not what I teach. I don't advocate doing that. There's folks out there that make a good living doing it, and that's not my style. And if you want to be doing that, that's certainly your prerogative. But I focus more on price swings that allow more dynamic delivery in terms of pips and don't require such a spin on a dime type execution where you have to be in front of the chart every second of the day. By trading in that direction, your trades are going to be limited to the cream of the crop, very high impact, very dynamic price response, and you get almost like an instantaneous feedback to your entries. And I don't know about you, but If I look at back over my history as a trader, even before I got into Forex and I was trading commodities and bonds and S&P, all of my trades that didn't really quickly turn into a profitable trade, generally that was like the, the banner, if you will, saying, hey, look, man, you got the wrong side of the trade. It's going to go against you. You'll find that many times your profitable trades turn profitable almost instantaneously, or at least cover the dealing spread very, very rapidly. And if you see that in your trade, it, number one, it gives you a lot of confidence to hold the trade, and also it gives you a lot of uh, stability in terms of your mindset. In other words, if you have a job and you're trading, and I know it can be very stressful if you're trading and you're looking at your smartphone, or if you have access to the internet and you're doing your trading at your desk. Um, if you have that immediate response where you're profitable, it allows you to continue on through your workday and then do what it is that you need to be as an employee, and then come back periodically and check the market. You won't have to be feeling so connected like you have to be checking every 5 seconds. All right, after we've conquered the monthly range and the levels on the monthly chart, you obviously have to work downwards, and we're going to be going into the weekly range. Now, much like the monthly, you're going to have to determine the current market structure. Okay, and we're going to talk about that more. If it's over your head right now, don't worry, we're going to talk about that. Again, much like we did on the monthly, we want to be focusing on the price swings and the turning points on the weekly chart. Now, you're going to find that many times that the weekly chart is going to have swings that aren't necessarily visible all too many times that's in the monthly chart. The larger ones, yes, but the smaller ones, you may not be so obvious to see. And obviously you want to be noting the key support and resistance levels on this time frame as well, because much like the monthly, the weekly chart has very, very large impact support and resistance levels. Okay, if the market's turned at these levels, and you can see it happening on these higher time frame, if a daily or hourly or less than 60-minute chart feed gets down to these price levels, it's reasonable to expect some kind of a bounce. And it doesn't necessarily have to be a 500 pip rally. Intraday, if you catch a 50 pip or more trade, a couple times a week, you can make a good living on that. Again, much like we did mention in the monthly, you want to be trading in the direction of the primary. Okay, and we're facilitating that premise by using the monthly and the weekly range. And again, we're looking at the highest high, the lowest low, in a predetermined amount of time, and we're going to cover all that during this presentation. So again, these are just for your notes. This is just for your reference. We're going to build on this as we go. Okay, but we're basically teaching you how to trade from a higher time frame perspective down, using range from a higher time frame to a shorter time frame, and then we're going to get into real dynamic specifics on how to narrow down real high end, low risk, dynamic entries and exit points. In the weekly range, you want to be looking for new optimal trade entry reversals. Okay, in other words, as you're measuring your price swings, you always have to be referencing where are we coming from and where are we heading. Okay, and it'll make much more sense when we see some examples, but you're going to learn to anticipate, and you're going to see the weekly chart, the daily chart, 4-hour and 1-hour chart give you that resource as a trader to learn to anticipate. A lot of traders find themselves reacting. Okay, and I'm a very big opponent to that type of trading. My opinion is, if you don't have a game plan before you even sit down at your computers and you're looking at the screens, if you don't have a premise in mind before you even turn the charts on, you are absolutely gambling. Okay, unless you're a really, really short-term intraday scalper, that's the only exclusion. Okay, and even then, I think it would be beneficial if you had a game plan as trading the higher time frame, even in that realm of trading. But my experience, not only as a personal trader and a fund manager, but my experience as a mentor, the feedback I get from the folks that are following me for years, not just on Baby Pips, there has always been this struggle with traders that they want to see something happening right on the chart. And you want to be doing your homework in like a Friday night or a Saturday when there's no real trading going on. Okay, and get your levels determined there, get your premise arrived during that time frame. You don't want to be watching the market and then trying to figure it out. It's kind of like when you go to the grocery store and you're hungry, you'll pick everything off the shelf, and your wife will look at you like you're crazy. But you're not going to eat all that. You're not going to consume all that. Well, you can't consume all the data that's being flooded in your brain while watching the charts and hopefully deriving a opinion or a bias to the market just by simply looking at live action. You need to be distanced away from live action because that way you're not going to be swayed. If you have a game plan at the beginning of the week, before the market even opens up, you won't trade every swing. You won't trade every setup. That's okay. That's one of the barriers to you and your development. You're going to have to overcome that desire to always feel like you're missing that move. You may see folks on the forums catch 150 pip swings. That's not your trade. You may see guys that are catching 500 pip swings that's been in for 3 weeks. That's not your trade. You may see a guy going in there and make 50 pips 3 times a day, intraday. Those aren't your trades. Your trades are the ones that you do the homework on, you arrive at based on your own analysis. You're not going to be swayed by anybody else's opinion, mine included. You're not going to be swayed by the talking heads on the TV, CNBC, Bloomberg, whatever. It doesn't matter what these folks are going to say because they can't spend your money. If you allow them to influence how you lose your money, who's at fault? You, because you're using outside influences to determine your premise as a trader. And I'm guaranteeing you, you will not have longevity doing that. You're going to be a sheep, okay? And I'm teaching you how to be an alpha male, okay? You need to go out there and be a predator yourself. See these things yourself, take them down by yourself, and then put your trophy up on the forums. Then talk about what you did. Don't talk about your trades while you're in them, because what you're really doing is you're putting it out there. Okay, and you're still basically in that reactionary realm of trading. You need to anticipate, then go in and attack, and then talk about it afterwards. Okay, so that's what you do as a trader. You learn to anticipate, then you execute, then you manage. Okay, that means either take the loss or take the profit and move the stop to break even, those types of things. But that's all in the realm of anticipation, not reaction. So you don't want to be a reactionary trader. And by using the weekly range and the concepts that we're going to share in this presentation, you're going to be a much more anticipatory trader than a reactionary trader. All right, obviously the daily range. You hear me talk about this more in any other time frame simply because it allows me to give what the dietary needs of forum readers is they want to see a lot more short-term premise to the market. They want to see what's going on right now. What can I do today? And that's why my reviews talk about intraday action, because it facilitates that need for traders. They got to be engaged all the time. So, my videos supply that. But I don't want you as a developing trader to live in that realm. I want you to think a little bit higher time frame perspective, and you can catch these trades where you're trading 2, 3, even a week or more in these position trades or swing trades. Now, the conditions aren't always like that, okay? But when you understand the current market structure on the monthly, the weekly, and the daily, you'll be able to understand where price is most likely heading, okay? There's always going to be retracements, okay? There's always going to be consolidations. That's not your concern. Your concern is where's your focus? Is it on the higher time frame primary direction? By having your primary direction in mind, you will be able to filter out a lot of the short-term noise, and you won't chase these 50 pip runs up when you're overall bearish. You're just going to look at that 50 pip run and say, okay, it's coming to me. And then you'll look for an optimal trade entry or a reflection or something along those lines to give you a short. Okay, and that's what this concept's going to give you today. In the daily range, obviously, you still want to be focused on the price swings that you see on the daily, and you want to be focusing on the turning points, that being the swing highs and swing lows. Obviously, much like we did on the monthly and the weekly, you want to be noting the support and resistance levels that are key. Okay, and by key, they're going to be very obvious. It's going to be a very significant price turn at these significant levels. Okay, and you want to be trading, obviously, in the direction of the most recent swing point when it is in line with the current market structure. And I'll give you examples as to what I mean by that. And obviously, much like we did in the weekly, you want to be looking for new optimal trade entry reversals and anticipate possible reactions to the current market trend in the form of a reversal, or it could move into a consolidation phase. And we're going to touch very briefly on market profiles in this presentation as well, so it might be a little bit more beneficial to you. Alright, the Asian range. Everybody sees this on my reviews, and it's essentially the Asian range action all the way up to midnight New York Standard Time, and that's the initial high and low of the dealers they set for the day. And then you see examples of that in my videos, but we're going to talk a little bit more about how we can use this in a more dynamic fashion as a trader, and it'll help you with really spectacular entries, for your demo account trading. So again, you want to be noting the initial high and low, which is established with the Asian range. If you don't have my indicator for MT4, it's not a big deal, guys. At London Open, if you just look at the time and just draw it out on your charts, you don't necessarily have to have MT4. I know we're all lazy and we have to click a button and then it's all there on the chart, but and I'm guilty of that too, because my time's valuable and I want to be doing as little as I possibly can in terms of dressing the chart. I just want to have the information and digest it, but you don't necessarily need it. Okay, but I'll just toss that out there because I get a lot of folks asking, well, I don't use MT4. Well, I don't trade through MT4 either. I just share the information to you guys because it's allowing me a platform to do so. But to each his own. Alright, on the Asian range, okay, we're going to learn to narrow our focus with the higher market trend. Okay, and that's the primary. It means the monthly, the weekly, and the daily. And we understand that, okay, we'll be able to use the Asian range in a much more user-friendly capacity. In other words, we're not going to be swayed by the breakouts that most traders chase. Okay, and I was actually looking at the couple of video channels on YouTube the last couple of weeks, and there's a lot of folks that are still really pushing this whole London Open breakout strategy where they use the Asian range and they'll buy, okay, and you hear me teach against this in all my videos, but they'll buy the resistant breakout, okay, and they'll sell the support breakout, and we'll cover that and we'll review that for folks that don't know what I'm talking about, because if you haven't seen my work before, and I'm sure there's some of you in here that haven't, you'll see what I mean by that. And there's a lot of people that follow that stuff, and they swear by it's the coolest thing in the world. And I think it's the reason why is they cherry pick the opportunities where it did work. But if you look at it on a larger scale or sample size in terms of good grief, 3 months, you'll see that many times the breakout initially on the other side of midnight in New York, the initial break of the higher low is really a fake out. And you can make a strategy on that, but just to do the first breakout and trading the break of resistance as a buy, that's many times that's not a good idea, and vice versa for selling the support breakout. So again, we'll talk more about that as we go. Obviously, the Asian range, you want to be looking at the key support resistance levels noted with old highs and lows. Now that's going to be in the form of previous session highs and lows, previous days high and low. Okay, now when I say session high and low, it means what was the highest high and lowest low in New York yesterday? What was the highest high and lowest low in London close? Asia, the previous London Open. Okay, those session high and lows intraday, and you'll see that like in a 15-minute chart. That's a very good bellwether chart for you to be able to use. And if you're stalking London Open setups, you should be looking at a 15-minute chart, not always necessarily a 5-minute chart, unless you're zeroing in on a real tight entry pattern, like the optimal trade entry or reflection. But overall, the highs and lows, you're going to be able to pull those out with a 15-minute and or an hourly chart. Now, you can also use a previous week's high and low and a previous month high and low, or the current month high and low, and then you have a quarterly high and low, and obviously the annual high and low, the rolling 12-month. And for more information on that, check out the ICT video I have, Trading Key Support and Resistance. You can find that on the Baby Pips thread link, and or you go to my video channel on YouTube and you'll be able to see that as well. And obviously, like we did on the monthly and weekly and daily, okay, when we use the Asian range, we're trading in the direction of the daily swing point that's most recently occurred. Okay, and you understand more about that and amplification with the Power 3 video and short-term trading module, and how to capture explosive profits in the Forex market. Those videos will be beneficial as well. I'm adding that here for future reference for folks that are just getting this video for the first time. And obviously, you're going to learn to anticipate the London stop rate. And when you see that, you fade that, okay? Because that's where the big boys are trying to dangle that carrot for you to chase after, because you're all hungry dogs, okay? And you're gonna chase the fresh meat that's dropped in front of you. And when you see that run of 20, 30 pips real quick, and you haven't done anything yet, and you got to get up in 4.5 hours to go to work, you want to get something for your time in front of the charts, and that's what you do. You end up chasing it. You'll buy the high, or you'll sell the low. Okay, and we're going to teach you how to avoid doing that in this presentation. All right, we're going to talk about the average daily range, or ADR. Okay, when you hear me talking about that, we're only going to be focusing on the 5-day average daily range. Okay, I use a 10-day and a 20-day as well. That's not my scope in this presentation to cover those, but generally the 5-day average daily range will serve you well. Okay, you want to align your trade expectation to the 5-day average daily range. Okay, every day, most currency pairs, okay, will usually fulfill their average daily range on a 5-day basis. And what that means is the average pip move from high to low for the last 5 days, you average that up, okay, and whatever that number is, that's your ADR. Now, it's a real quick down and dirty way of doing it. If you trade the majors, it's generally you see about anywhere between an 80 to 100 pip ADR. Okay, that means the currency pairs usually move about that much. Now, it doesn't always fulfill the average daily range, and many times the average daily range isn't respected at all, and many times it'll be twice the average daily range. And you get those types of events when you have the higher time frame in mind and the trends unfolding in that larger time frame direction. Everybody's on board, banks are on board, everything's moving, it's all one-sided. Okay, and you see these 200-300 pip rally days, which we don't see too many times recently, but you know, a year and a half, 2 years ago, it was the standard. You know, everybody was excited to see that type of thing, and if it was 100 pips, it was a slow day. All right, you are going to stalk your average daily range objectives once you enter your trade. Okay, and we're going to talk about trade entry, and we're going to talk about trade management, stop place, and all that stuff in this presentation, but we're not going to be looking to get out simply because you got 5 pips. We're not going to be looking for 10 pips and saying, you know, I hit a home run. That's not the type of trading I teach. Okay, so if you're used to that type of thing, you're going to be probably surprised with how much you can make in pips versus trading like that. And you don't have to do a whole lot of work doing it either. Okay, obviously you need to learn to blend time of day and price theory. Okay, and that means there's specific times of the day we're going to talk about. You've heard this before, but I have to do it for completion's sake, because folks, I have no idea when they jump on board on the ICT train. I don't know if they're just coming on board now or if they just started, you know, yesterday. I don't know where you're at. I don't know what videos you've seen, so I kind of always have to toss this out. And I know you guys have been following me for years. You know, this again, it's just boring. It should be boring to you. That's good. All right, and obviously you're going to anticipate profit objectives near the average daily range, okay, because I teach exiting during the move, not right at the actual highest high of the day if you're trying to be selling from a bullish standpoint. In other words, if you're long in London and the average daily range is, you know, 100 pips, I'm not getting out at 100 pips. You know, I'm getting out at 80, 90, something like that, because number one, my positions aren't one lots. I want to be able to execute while the price is moving in my favor, not during a retracement. Okay, so I want to be getting out during these big bold-faced bullish candles, and you're going to learn that this presentation as well. And obviously we've learned that we anticipate and learn to expect the 1500 to 1600 GMT hour, and the average daily range converges with other technicals. They confirm very handsome profit taking objectives. Okay, and we'll talk about that more when we get to the charting section. Alright, so how do we enter trades? Okay, we're going to talk about some of that today, but you're going to focus on optimal setups. Now, you're not going to see a trade setup every single day. You're not going to. Okay, when I was doing the daily Pro Traders Club videos, you know, I would review the market, but I would also tell you I didn't do anything today. And there may have been a very handsome price move. Doesn't matter. That wasn't my trade. Okay, so what does it mean by optimal setups? There's going to be optimal days of the week where you want to be trading. Sunday is not optimal. As much as it feels like it's optimal because you haven't been able to trade Friday night and Saturday, okay, you want to be in there doing something. That's not optimal. It's not because you're off of work and you have some time before you go to bed before your job starts the following day. That doesn't make it optimal. As much as you probably would like it to be, it's not. Monday generally isn't an optimal day either because there's a lot of data that's coming out that the market has to digest, and it usually prices in the higher low for the week between Sunday and Monday going into Tuesday's London Open. By applying the Power 3 and range expansion concepts and understanding that Sunday and Monday going into Tuesday's London Open generally is pricing in the weekly range high or low, you don't have to be in there trading. Okay, you can wait, and you're going to be waiting for the setup to unfold for the weekly range to be established a higher low. In other words, if you're bullish overall on your currency pair, you would ideally wait for Sunday's trading. Just watch it. You just want to be a spectator, not a speculator. You want to be watching Monday's price action. Again, spectator, not a speculator. You want to hopefully watch price pull down into some kind of a low. Because remember, if we're bullish, the market's going to go up, what? Not one day. It's going to go up a day or two, 3 days, even for the week. And that's what your understanding as a professional should be focused on. Not what's it doing this hour. What can I make in this next 30 minutes or during my lunch break? Or I'm off today. I'm home from work. Let me just see what I can squeeze out of the market today. That's not how you should be trading. Okay, you need to get yourself in sync with how the professionals work in this market. That means there is a very generic rhythm to the markets. Okay, and it's so generic that if you just look at the whole week and break it down on a daily basis, Tuesday usually is the higher low, and then it usually unfolds the rest of the week. Okay, and the only time it deviates from that is if we're in a very uncertain consolidation where there's a lot of news events or a global event that came out that was unexpected and it shocks the market, then it has to figure out what it wants to do. Well, by far and large, you're going to see that by looking at the weekly range, okay, and you can see this on a hourly chart. Just plot this on an hourly, okay, and then delineate your days of the week with vertical lines. And if you use MT4, just pull it up an hourly and hold down Control, hit Y, and you'll see everything broken up. And all of a sudden, you'll see how the market usually prices in the weekly low, and then rallies up, consolidates, pulls back. All these little retracements intraday, and then Thursday into Friday, making the high of the week and then closing. Okay, and vice versa for bearish environments where you'll see Sunday and Monday going into Tuesday's London Open, it forms the weekly high, and then you'll see the sell-off, and then every retracement therefore on Tuesday, Wednesday, and Thursday just sets up another selling opportunity going into Friday's close. Now, it doesn't mean that Friday's close is going to be the absolute low or high of the week. It just means that you are in sync with that expansion of the weekly range, and you're allowing for that to happen, and you won't be so rushed to get out of these trades simply because you're up 50 pips. Okay, so it'll make more sense as we go along. Again, like we just said, if we're bullish, we're going to be anticipating the banks to sell first. Okay, that means they're going to drop price down into a larger buying opportunity. Okay, and then that's when they'll accumulate. That's when the retail traders are clamoring on the forums. It's a short. I'm selling. I'm up 15 pips. I'm up 20 pips. I'm going through the bank, skipping, and is happy about everything. And it's not. That's not what happens. All of a sudden, it spins on a dime. It starts rallying up, and then you see them later on in the chat rooms or the forums scratching their head. What just happened? They're asking everybody what happened because they're not looking at the higher time frames, and they're not expecting or anticipating these events to unfold. Just like we just mentioned earlier, when it's bearish, anticipate the banks to rally the market up first. Okay, they're setting up a suspect rally. It's all engineered. Okay, they're driving price up there because they need open interest to establish the other side of their trades. They're going to drive this market lower. They want to get short, so they have to entice the market participants to get in there and chase the market. So they run it up, and many times it looks very dynamic. It's very enticing. Folks get on there and they start buying. Everybody's talking about it. Everybody's clamoring about it. Boom. It's over. They put the brakes on it, and he starts driving it lower. You are going to learn to exploit the raids of old swings, and you're going to exploit patterns that form and to confirm entries at those particular price points. And that means like a Judas swing, that means like a reflection, it means a turtle soup pattern, and all those patterns, you can learn more about those on my high probability trading patterns video also. But generally, you're going to learn to blend a lot of these things, okay, together, and it'll give you a cohesive approach to, number one, being patient, because that's a struggling point for, I think, 99.9% of you folks. You feel like you got to get in there every single day. It'll give you a game plan and what it is that you're specifically anticipating. It's one thing to say, okay, well, ICT, I hear you talking about what you're anticipating. What is it specifically you're anticipating? We're going to go through that. But these are the salient points. These are the ingredients to an effective trading model. Okay, and this will give you the primary tools to build a very good foundation to trading. All right, this is what everybody's really interested in. And how do I get paid? Okay, what is the profit objective? Well, obviously, like we said earlier, if the average daily range is approximately 100 pips on average, we learn to take profits at around 80 pips. I'm okay with leaving some on the table, okay? But if I'm in a position trade or a short-term trade, I'm going to take a position that's going to allow me to take some off. Number one, I'm going to have initial first profit. Okay, that's 20, 30 pips. And it's usually based upon where the optimal trade entry, high or low, is from. And I'll show you what that means later on if you don't know what I'm talking about now, if you're new. But generally, we take the first profit around 20, 30 pips, move to break even, then we take another larger position off at, in this case, the average daily range would be about anywhere between 75 and 95 pips, something like that. But a good bellwether number to reach for is 80 pips. Then, if I'm in sync with the higher time frame premise, I'll leave a portion of the trade on, 10, 15, 20%, depends on what I have left over on the position. But I still maintain a break even because I've already been paid, and I will allow the market to retrace back. Because think, if I'm in a swing trade or a short-term trade and it's early in the week, Tuesday or Wednesday, I still have Wednesday's trading, Thursday's trading, and Friday's trading to fulfill that weekly range. So even though I'm up and I've taken profits on 80 and I've also taken profits at 20 or 30, if I have 20% of my original position and I still have 150 pips left to move, okay, and I still have that 20% on from the initial position entry, I can make a lot of money just on that 20%. And it also frees me up to, number one, I can counter trend trade the other pair. Everybody knows that I'm a fiber and cable trader. So if I'm long cable, if I'm bullish on cable overall, if I still have that short-term position on in cable, I can short-term or scalp short positions in the fiber when it gives me an opportunity to do so, and still not be worrying about my cable trade that's long, and let that fulfill its weekly range and still short-term scalp the fiber. Okay, so it really adds a lot of punch to your bottom line and your weekly results. You have to develop the mindset of looking to take some out. Okay, I have a lot of guys that send me emails saying, look man, if your stuff's this good, why don't you just hold your entire position to get your targets? Well, here's this short and sweet answer. I'm not always right. As amazing as that may sound to you, as shocking as it is, okay, it's going to hit the newspapers tomorrow. ICT came out and said he's not always right. You're absolutely correct. I do not always have it right. And it's not imperative that you have it always right. Okay, you just need a small chunk of this market, okay, to carve out a very, very handsome living. And if you build a very strong perspective on how it operates and then build your mindset around that, don't you force your will on it. You try to get yourself in sync with how the market works. Okay, and by doing that, you can fight off that emotional response, because when we first start as traders, we get mad like it's a game, like it's a board game or a video game, and you want to get revenge on it. And you're never getting a revenge on it. The market's still going to do what it's done for years and years and years. And finally, when you break as a trader and say, you know what, I'm going to do what it's going to do, and I'm just going to ride on the coattails of those that are more knowledgeable than me. And that's all I do. I look smart to everybody, but only thing I'm doing is submitting. I am submitting to those that have more influence and more power than me in this marketplace. And all I do is look for the clues that they leave. I am not going to stand in front of an elephant. I will wait for it to pass me by, look at its footprints, and then it's going to follow the footprints. And then watch out for the occasional deposit that it might leave, and then you know what happens there. Average daily range does not, again, repeat, does not have to be fulfilled. Okay, and I know that that may be gray area for some, because you want things to always work out a specific way. You want it to be black and or white. But unfortunately, you're going to have to reside in the area that's gray. Okay, and there's beauty in gray. That means that simply because the market isn't that perfect all the time, it doesn't require you to be perfect all the time. It just means that you have to have a game plan that allows you to get profit even when you're wrong. So think about it. We're going to go back to that example. Say you were long on the cable, okay, and you took first profit at 20 pips. Then you took profits at 80 pips, but the average daily range saying it's 105 pips for the day. Well, if you held your original position all the way up to 90 pips profit, didn't take anything at 20, didn't take anything at 80 pips, then you watched the London close put in a reversal pattern that you didn't anticipate or didn't see coming. All of a sudden, by Asia that same night, okay, it's done retraced all the way down and back to your original position. Do you want to go through that? I used to. I used to do that. And the whole time I was hoping and hoping and hoping. Well, if it goes down 10 more pips, I'll probably get out if it goes down 10 more pips. Well, it goes down 20, and I'll regret that I didn't get out 20 pips ago. Okay, and then I've watched my entire profit that I had just erode and then get stopped at a loss. I've done that. Okay, I've done it. And unfortunately, if you don't have a game plan, taking something out, you will eventually go through that. If you're a new trader, you will, because you don't have the emotional mindset, you don't have the fortitude to say, you know what, I can take this and be happy. Okay, and if you get first profit and then it goes back down to break even, you made 20 or 30 pips, guys. How many people are consistently doing that on the forums? You don't see that a whole lot. You really don't. You don't see it. Okay, you see a lot of people asking questions. What do you think this is going to do? If the guys that are making money are on there asking what the other people are doing, they're not making money. I'm not asking anybody what they're doing. Okay, and I guarantee you there's a large block of traders, okay, that are actually profitable, and they're watching everything that goes on. And I'm not trying to make fun or poke fun at anybody, but I'm just trying to get you to see where you're at and hopefully steer you to where you really should be wanting to be or aspiring to be. You don't want to ask anybody what their opinion is. You don't want to ask them where you're taking profits at. You should know where you're taking profits at. And the average daily range is just one tool. It does not mean it's always going to be fulfilled. Okay, so it's very important you understand that simply because the average daily range is 100 pips and your indicator for MT4, ICT shared, or however, whatever other tools that's out there you guys may be using, it does not guarantee that the average daily range is going to be fulfilled simply because you have something in your chart saying, look at this level, it's probably going to go up there. Okay, you want to be looking for something technical to line up with that level, and preferably a little bit lower, actually. And by doing that, number one, you're going to have consistency. 2, you're going to have peace of mind. And 3, there's no greed. Think about it. You've eliminated the greed. You already know where you're getting out at. You're not going to sit there and when it gets to 90 pips say, should I hold if it goes past 105 pips? If the average daily range is 105, it's trading 112. Man, it might go up to 200. It could. It very well could. But statistically, it probably ain't. And that's what you need to think of as a trader. You need to develop the professional mindset in targeting. And that means simply knowing in advance where you, as the trader, not ICT, not ICT's friends on baby pips, not asking everybody else where they're taking profits at, where you, as the developing professional trader, where are you taking profits? And you have to have that written out in pen, not pencil, and have that right next to your trading desk. Okay? If you are not having a notepad next to you when you're at your charts, again, that is a weakness. Okay, you need to have your notes, you need to have a game plan, because I'm telling you, if you have something come out across the wires that was unexpected, okay, Japan had that nuclear reactor issue, okay, something could have really been worse than that, okay, you don't think that's going to send ripples through the market? Okay, if that happens and you're in a trade, what's your plan? Are you going to sit there and watch and just see what's going to happen? Or you're going to have it in a paper next to you and say, okay, well, if this happens, I'm going to do this. You need a roadmap and a contingency plan. and you need to have it written out. And by having that, you look to it and say, okay, there it is. When you're driving on the road and you get an accident, okay, first thing you're looking for is what? A sign for the exit ramp, because you don't want to sit in that mess. Same thing with your trading. You need to have it written out, because it's going to give you the focus to say, okay, this is what I'm supposed to do. I'm just going to get out. And if it was a loss you're taking, beat yourself up about it after the fact, because that little loss that you're into right now could be 3-4 times bigger than that if you stayed in. Okay, and you always have to have that mindset as a professional. Preservation of capital is the initial responsibility as you trade this market. It's not the appreciation of capital. It's the preservation, because it's people like me that want your money. Okay, I do this stuff for free, but if you're foolish enough to get in here and trade without having an understanding what's going on, I want your money. Okay, and that's the mindset you should have as a trader. There's folks out here that are gambling, okay, and they have no business in this marketplace. So if they put their money up and they lose it, it's on them. Okay, we all sign the same risk disclosures. But you do not have to be that victim. You do not have to be that pawn in this game it's played every single day. Okay, there's a way of carving out a small piece of this marketplace and make an absolute mind-blowing living. Okay, and it's my goal for you to experience that. Okay, and I want to see the stories that you can share with me. I'm not selling anything. I'm not trying to make anything off of you. Okay, but I want your story, because number one, it is invigorating to me when I see that you've made profits, okay, and your trades unfolded like you've planned. That's absolutely, it's amazing to me, because I've been able to share, and I like that, because I knew how it was when I first started, and I had nobody telling me this is how you should be as a professional trader. I struggled with it, okay, and I took a kitchen sink approach to a lot of the things that most people have, and when I realized that majority of it was, contrary to what actually goes on in the marketplace, then I started making money. So I'm kind of like pulling the curtain back and letting you see what really goes on. And all you have to do is just practice in the sand, use a demo account, and you come to your own conclusions whether or not you want to put real money at risk on it. You have to leave greed out of this process. Okay? When we talk about the trading concepts, we have to, number one, know that simply because it worked yesterday or the last 15 times, it's not guaranteed it's going to work on the 16th time or the 17th, 18th, 19th, or 20th. You may have a string of losses. If you take a loss, you got to trim back your risk. Okay, don't think, okay, well, I took a 2% loss, let me average up, and I'm going to do 4 lots this time. I traded 2 lots, let me do 4 because I can get it back with half the distance. Don't do that. Cut greed. Leave greed out of this. Okay, if you just focus on doing what you're supposed to be doing, greed has no part in this. I promise you, if you just do what you're supposed to do, the numbers will take care of themselves, and you will be more than pleased with it. Okay, I tossed this out there in a tweet earlier. I asked a question, and I asked simply, what would you do with 10% return on your investment 9 months out of 12? Okay, and I was impressed with some of your responses on Twitter. Some of you asked, well, depends on how large the loss was on the 3 months. I didn't say you lost money. Other folks said, well, I would let my money compound and build from there. Okay, well, that's fine too. But everyone filled in the blank that I left. There was 3 months out of the 12, there was nothing mentioned about percentage return. Okay, and the market review that we do later on in the middle of the week, because you guys got to give me a chance to take a break because I'm doing this presentation today, probably like Tuesday. I'm going to share with you a teaching on 10% and the possibilities of getting that, and what you could do with it, and I'll show you the mystery about the 3 months. Okay, at that time, but greed, okay, will tell you, well, if I made 10% this month, man, I'm going to go for 30% next month, and all of a sudden you take a 20% loss. Okay, because you were greedy. Leave greed out of it. Be happy living in the 80 pip realm. If it's 100 pips that your technicals are telling you, be happy with 80. Who wouldn't want 80 pips? Give me 80 pips. I'm going to take it every time you give it to me. Okay, and that's how you should be thinking. We have to work so hard to overcome our mental barriers as a trader to make money. Why would you want to make it even harder by allowing greed and fear to be barriers to you as a developing trader? Okay, there's tools and concepts and applications in trading that help stave off those influences, greed and fear. But the number one thing that's going to kill you in this business is the greed. Okay, because it's like an ATM machine out there. It's real easy to reach out and grab money. But I'm going to tell you right now, there's somebody on the other side of that screen that has a bigger hand than you and deeper pockets, and they can take a whole lot more of your money than you can take of theirs. All right, professional order placement. Okay, a lot of guys are on the forums and they're in the chat rooms and saying, I'm buying at the market now, or I'm selling at the market now. And to me, that, hopefully by now, if you've been paying attention, that illustrates one glaring attribute about them as a trader. Number one, either they're very short-term scalpers or they are reactionary traders. Okay, and as a professional, I'm not reacting. The only time I'm reacting is if my trade is now going against me and I'm going to hopefully protect my stop and reduce the amount of risk exposure I have. That's it. 90% of my trades are entered on a limit and they're exited on a limit order. Okay, limit orders will, number one, facilitate the best prices because you're going to be able to limit what you are willing to get in or get out at. Two, it gives you control. Okay, you dictate to the market what you're willing to pay, and if the price gets to that point, you'll execute at that point. If you're just in there clicking at the market, okay, you're reacting, and there's no need for that. There's absolutely zero reason for a market order entry unless you're a short-term scalper and you're just trying to catch little, blips in the marketplace. And to me, that's gambling. Okay, you can argue about all you want, but that's gambling. If you're not catching 20 or 30 pips, that's just, you're just really, really ultra short-term. And market orders, in my opinion, are a last-ditch protection. Okay, you have my permission to use a market order if you think that your trade is now somehow broken down, okay, and your stop is in jeopardy. Why risk the entire stop? Collapse the trade, take yourself out of the market, and then reevaluate it. Okay, but limit orders for entry and exits, that should be your primary focus as a developing trader. Learn to use limit orders because number one, it's going to force you to understand what level it is that you're trading off of. It's going to force you to a time of day approach, which is very, very important because central bank traders and dealers are going to come online specific times of the day. And you can learn more about that in the ICT video, Trading the Key Market Swing Points video. And you can check the YouTube channel out there too. But by having a limit order, again, it's allowing you as the trader to be in control of what it is that you're willing to do as a trader, getting in and getting out. Okay, now simply because you have a limit order in there doesn't mean that price is going to get to that point. Okay, and there's going to be times where you miss the trade. I miss trades. Many times my exit orders will go right to a fraction of a pip. It won't execute. Then I'm past the 15 to 1600 GMT hour where I would hopefully have been taking profits by then. If I want to be out of the market, say it's Friday, okay, and I've been really fortunate to catch the weekly range and it's London close on Friday. If I haven't seen my limit order pegged and it went like a fraction of a pip to that limit order and then retraced, I'm not going to sit back and hope it gets there if it's 1600 GMT. I'm going to use a market order, collapse, get out, and be done with it. Remove all my existing stops and other limit, and that's it. I'm going to be done. That's the way I use a market order. It's a last-ditch protection, and I don't ever really go in there and try to use market orders to get in there. Now, with all that said, there's one small exception. If I see that I was wrong on London Open and my limit orders to sell, okay, don't get pegged. In other words, they don't go hot. I'm not short. But the market has now shown clear evidence that it has already priced in the high of the day. I will at that moment do a market order. Okay, but that's the only time of day where I will actually use a market order versus a limit order to enter into a trade, because number one, I have the volatility on my side in London Open. I understand that animal more than any other. I'm comfortable with it. I understand its characteristics, and it's just something that I'm just tossing out there as one small little deviation to the rule. But that's just how I approach it. You as a developing trader, you should let the market trade and not chase it. Don't go after it. In other words, don't do a market order. Trade another day. Okay, and you'll see there's no reason to chase it, because if it's making a move today, it's probably going to give you another one tomorrow or the day after that. Okay. Do not try to get the very best entry price. Okay. I shared with you guys one of my oldest entry techniques, the optimal trade entry, OTE. And a lot of folks, when I first introduced it, they were thinking I was always trying to get the 79% retracement level as my entry. And that's just the farthest boundary it usually goes back to. And then the 62%, generally 62% retracement plus the spread, okay, and maybe a pip or two. I use that as my entry, okay, many times. If I'm real confident I have the market symmetry under grasp, and I understand where price is probably reaching for based on time of day and support and resistance and all that, I will try to use the sweet spot, okay. But generally, it's anywhere between the 62 and the sweet spot. That's where I live in terms of my entry, because I want to make sure I try to get in there, and once I get my position established, I know where I'm going to have my stop, and then I'm done with it. I'm going to hopefully take a nap and then be up around 5:30, 6 o'clock, and babysit the trade and see what happened. But you should not be trying to get the absolute best price, because the best doesn't always unfold, and the best is always trying to be taken by someone else, okay? And you may not get it. It may go up there just a fraction of a pip away from it, and you miss a trade. So give yourself the 62% up to the sweet spot on the OTE, and you'll see that yourself getting in the trades more frequently. The risk isn't greatly enhanced because of your early entry versus the 79% retracement. It's optimal because it is optimal. Okay, you'll have a predetermined stop placement based on that pattern, and you don't necessarily have to have the best price all the time. And if you're looking at a 5-minute chart, many times we're talking about 10 pips or less between the 79 and 62% retracement. So really, are you going to haggle over that number of pips? Come on. Do not try to exit at the very high or low. We've mentioned this earlier. When we're talking about the ranges, okay, and we see examples of that, simply because the old resistance level provided resistance, day or 2 or 3 days or even years ago, doesn't necessarily mean it's going to happen to the pip today. It may be a few pips below it, okay? Remember, there's always the spread has to be factored, and they only need the spread to make those orders go hot. So if they run it up to an old resistance level, okay, that is enough just to be the spread minus that particular price level as a resistance level for those pending orders to be triggered, and then they'll pull it away. Okay, and if you're hopefully trying to get out with a profit on the other side of that resistance level, you may not necessarily get out. Okay, so don't always try to get that. 80% of whatever range we're working within, and then we'll talk about that, and we'll talk about dealing ranges too, and then we're almost at the part of the charts. I know I'm boring you guys, so shake yourself up right now. There will be a far greater chance of you getting 80% of your potential targets than you actually trying to reach for the ultimate high or low. Okay, and hopefully you've seen that in my videos where my tools suggest that the 200 extension is at 124.50, okay, and I'm taking profits at 124.40 or 124.35, 10 or 15 pips below that. I'm okay with that. My tools are telling me where it's going, and I relish in the fact that I had it right analysis-wise, and I still made money. If it doesn't get up to that point, and I got out of the profit, okay, even though my tools suggested that 200% is up here at 50, and I got out at 35 or 40, and I got paid, I matter more about me getting out of the trade profitably and keeping risk under control versus being right and saying, look, I called the pip from the low to the high. Okay, that's not my intention in teaching you. I'm hopefully not teaching that for you as developing traders to be able to think that you're going to go out there and catch the low of the day and the high of the day and consistently do that over and over and over again. Because if you do, start a service, I'll pay you. I want to know how to trade like that too, because I don't have the brass to do that every time. Okay, and you may become a better trader than me, and it's my goal. I'm content with what I do, but I'm not trying to teach you how to catch the high and low of the day. You can anticipate a high and low to form and then trade in that direction, and have tools to suggest where price may go as our parameter, but by no means am I saying that you should stay in the trade to get to that actual price point. Okay, so very important. Again, you always have to factor the spread plus 2 or 3 pips. Okay, and by that, use cable 4 pips, so 6 to 7 pips I use as a buffer for looking for entry points. So I'll add or subtract 7 pips for cable to allow for slippage, allow for you know just things that generally creep into real live trading versus what you end up doing in a demo account. Alright guys, we got all the way through the boring stuff. Okay, so let's take a minute, let me get a drink real quick, and then we're going to take a look at some charts. Okay guys, I just want to double check, make sure you guys are still hearing me. Okay, thank you very much. Alright, so let's talk about what it is that you're supposed to do with all that information and actually put it to use and how you can use it this week going forward in your demo account. Alright, this is a monthly chart on the euro. Okay, and what we're going to talk about is the monthly range, and we're going to break down that and how we can use it to go down to the smaller short-term time frames and use that to nail down high odds, very dynamic price action trading, and hopefully at the same point reducing the overall risk as well. In other words, we want a very handsome reward to risk ratio in our trades, and hopefully with this presentation you'll have some insight on how to do that as well. I took a very small sampling of some of the things that you're getting in the trading plan development series, and a lot of this is familiar to most of you because you've been following me for so long. I'm just going to amplify a few little things in here and not give too much away of the trading series, because there's a lot of stuff in that I haven't really given away before. But let's just get into some examples here. This is a monthly chart. This is the most recent high and low. Okay, and by noting that, what we're going to do is we're going to use this level here and this level here. Okay, this is the current range on the monthly chart. Okay, and the reason why I'm saying that is because we have now already seen a higher low form. Now this may break away. Okay, this may break away when markets trade Sunday into Monday. Okay, because right now we're talking pre-market. So depending upon what happens in here, if this one breaks, then obviously the range is this old low here. Okay, but for now, simply because we have closed last week with a higher low, I'm sorry, last month rather, with a higher low, there would be no need to look beyond this point here. Okay, so obviously price would have to move a great deal, okay, between where it's at and here. Okay, but if we have the monthly range determined like this, okay, we are in what would be considered the low end of the range. All right. If at any time price were to break below this low and then re-challenge this one, okay, it would indicate that probably it would be reaching for this low as well. Okay, and then I know this is a lot of price movement, okay, but we are looking at a very large time frame, and you have to look at these things, and you'll see why I'm referring to it like I am now. If price was to rally up, okay, if it was to move up from here, okay, this range high down to this low, okay, the levels that would be noted and considered, obviously optimal trade entry is way up here, okay, way up here. I don't see it getting there, but this is how we do it. We map it out and look for all the individual levels. The 23.6 level is an interesting level to watch, okay. The 38 and the 50, okay, interesting levels to watch as well. Okay, so those levels you'd have noted on your notepad for very large, high range upside levels to watch. They're not always going to be referred to, obviously, when you're looking at your price action intra-week or intraday, because they're so far away from it. Okay, but if you don't have these levels in your notes, you're just not going to be aware of it. Okay, and it's not going to draw you back to these higher time frame price charts. This high here and this low here, okay, you could have done this. Let's get this off here. You could use this low up to this high here. That was the monthly range when this monthly high was lower than this one. So it's priced in a swing point. Okay, let me zero in a little bit. Okay, see how this candle has a lower high than this one? So we have a swing point here. Okay, let me move that away for a second so you can see. See that? That's a swing high. I'm going to plot that indicator that I was referring to earlier, the MT4 indicator, the fractal indicator. What it's going to do is it'll show you real easy how you can see the swing points. Okay, so here's a swing low, here's a swing low, here's a swing high, swing high, swing low. And by looking at these on this higher time frame, it gives you, again, these are monthly ranges. Okay, each one of these candles is an entire month's worth of trading. But when you have that in conjunction with the concept of ranging, okay, this low to this high, you could have pulled a fib just using one pattern, OTE. Okay, here's the sweet spot right here. Here's the 62% retracement level, and here's the 79% retracement level. Okay. As price came down and entered into optimal trade entry area in here, this candle represents January of this year. Okay, and then you saw price bounce up in here. Okay, now I know it probably doesn't look very exciting because in terms of the larger movement of these ranges, but that's almost 900 pips. Okay, 900 pips inside of 2 months of a bounce. Okay, I don't know when's the last time you made 800 or 900 pips. Okay, but trading, what we're going to talk about in this presentation, you're going to have a whole lot more understanding on how you can do it, and hopefully you'll be able to walk forward in the next 4 to 6 weeks and be able to ferret out something and pull out a lot more pips than you usually do. But this is how we map out monthly ranges. In other words, you look for an old high and old low and see where we're at in terms of the range. Okay, see this high and this low. Now obviously I'm using old data. It's all hindsight. Okay, but these are all areas where I actually did live trading. If you go back to my old videos, you'll actually hear me talking about this one here before it actually happened, and you'll hear me talking about this low here as it was happening. Okay, and it's all there. It's before the fact. Okay, you'll actually you'll see me in the trading plan development series actually do a top-down analysis for the April-May spring decline that we had in the fiber and cable, and actually show you my real trades where you can see where I've did some shorting and made $425,000 just in just those two pairs, just trading the swings from the spring. And it's very important you understand that you want to make serious money. You make money doing it like this. Okay, it's not the willy-nilly 5-minute pip movements. Okay, that's not how you make money at this. The banks aren't doing it like that. Okay, they're trying to catch these very large extrapolated price swings, and they're the one driving it. They're the ones steering it. Okay, so hopefully when we're done here, you'll have some tools to work with. See this high here and this low here? When price was trading like that, just look like this. Okay, this was the monthly range that would have been noted on your chart. Okay, and when we close, I'll give you what we're looking at real time too, so that we're not just looking at hindsight stuff. And I'll kind of like more or less facilitate a weekly market review in this too as well. But here's the sweet spot. Here's the 62% retracement level, and here's the 79% retracement level. Okay, so what we're going to do is we're going to note that level. That's the upper boundary level for the sweet spot, optimal trade entry, and 62% retracement level. Okay, so right in here, this whole area is where you would be looking for a high to form. All right. Notice on this monthly range, okay, we formed a lower high than here. Okay, so this is a swing high. I do not require a second lower high like this indicator does. Okay, this little arrow here, it's indicating that we've made a high with two lower highs on both sides of it. Then this area will form. I do not require that. As a trader, I learned this from Larry Williams. It's just basically I need a 3-bar pattern at an anticipated level of resistance or support. This is an area where I was already anticipating price to form a high. If you look at the price, it was the sweet spot was 149.42. Okay, and this was a very big trade. But when it gets to this point and starts to turn, what you do is you go back and say, okay, now if we're turning here, okay, in other words, you would see this. Take that off, it's still distracting to me now. This high and this low becomes the monthly range. Okay, because now price is now starting to turn down as we anticipated. Okay, as we would have anticipated based on that retracement from this high to this low, price has retraced back to optimal trade entry. Once it's turned the corner and starts to go down, we have to now measure the high and the low here, because now this is now the new monthly range. Okay, this is the new monthly range. So by doing that, let's take this off as well. Okay, by doing that, we take the fib and pull it from the low up to the high. Okay, now we have the 79% retracement level here, the sweet spot here, and the 62% retracement level here. Okay, so we're going to note those levels again. And you can see you don't have to do this a lot. Okay, you're very limited in amount of time you're actually doing these higher time frame measurements. Okay, but once you arrive at them, okay, this is a level that you would reasonably expect price to reach for from here. Okay, you want to see it reach for that point. But since we have priced a very large decline here and then retraced back up in here, market structure and everything broke down here. Okay, this is not conducive for another rally up above these old highs. So really we would have been pricing a longer term price swing to at least very minimum retrace back down to these old lows. Okay, and if you go back to the optimal trade entry video where I actually teach how to trade with that pattern, which is what we're using here, the target is always first try to reach back for this old low In this case, it was a retracement back to an old low, and you see price go down to it just by a little bit in terms of what it looks like on this chart. But again, not appearing as much really is 460 pips. So it's a lot, okay, in terms of pip magnitude. Okay, now when price trades down to here, okay, we now have a new range. We have this low and this high. Okay, so the chart would look like this at the time. Okay, so you have a new range here. You have a high here and a low here. So if price turns the corner, as we see here, we have a swing low formed. Price may start to rally back up into the retracement of this high to low. So you take your fib, pull from the high down to that low. Here's your 62, sweet spot and optimal trade entry levels. It goes right to the optimal trade entry sweet spot and then sells off. Okay, it trades all the way back down in the tune of roughly 1,400 pips. Okay, roughly 1,400 pips. So that's a pretty significant price swing. Okay, we're not talking about 20, 30 pips, guys. We're talking about real opportunity to get some serious pip influx to your account. Now, as price starts to trade down in here, okay, all the while we're doing this, we have not factored in anything except for the Fibonacci retracements based on price swings. Okay, just on price swings. When you add to that support and resistance levels, it adds a very large dynamic to the overall concept. In other words, you can blend all kinds of support and resistance concepts like pivots, which we're not going to cover here. I'm not going to put monthly pivots up or weekly pivots or daily pivots. Okay, you can do that on your own because I'd be here with a 5-hour presentation. I want to hopefully try to narrow this down and get done by 6 o'clock. So we got 45 minutes to finish this. But you have a very handsome drop down here. But here's the thing. If you see the swing low, okay, you could look for price to rally up to at least the optimal trade entry level of this high to this low. So it gives you a anticipatory realm to reach for upside objectives, even if the overall price structure is bearish. Okay, and then obviously you see price trade down in here as well. Okay, because we entered into an optimal trade entry retracement level from the high down to this low. Now we see price rallying all the way up, and it breaks this one here. Okay, when we get down the weekly chart, we'll probably see something in here that I can pull out and give you something. But for here, if you're just looking at the monthly and you see price break through this old high here, what is this? Well, we have this range low and this range high here. You see that? Here's the high and here's a low. Okay, we've already went through this optimal trade entry realm. We're through that one. So it can't be an optimal trade entry from this high down to this low. We've already violated that range. So now we got to go and take a step back. What's the next range to consider? It's this high to this low. Watch what happens when we use that. Here's your optimal trade entry sweet spot. Both of the body's candles on the monthly stopped right on that 70.5. That's the level we actually use for Fibonacci to give the sweet spot. In the case, this is the 1.4807 price level. And then you obviously see the high form here with the lower high here, and then short. Where it's going to go back to, at least try to reach for this as an ultimate downside. But before that takes place, this range has to be referred to again. So this low up to this high, that's the range that this is retracing back into. So let's pull up a fib real quick and look for where the OTE would be in that for at least a minimum downside objective, which is here. Here's a sweet spot. Here's the 62% retracement level. And you can see price did that little bit of a bounce in here. Okay, and we talked about that earlier, being pretty significant bounce. But ultimately, we have yet to come back down to this old low. And we still could very well do that because we aren't that far away from it. And we did retrace deep enough, I think, that this range is now broken and we may see a pullback down to here and then maybe even so far as this low here. So if you want to see some long-term targets documented, I'm giving you one more of it here. But that's basically what we do with the monthly, and again, it's assuming no lines for support and resistance. Obviously, we're not going to go into that here because it's seen in another video, and every week I do basically the key levels as well. But let's break it down to a weekly and look at it in a similar fashion. Okay. Now presently, the weekly range, okay, let's put some lines on here so I can plot these across. Hopefully you guys are learning something. I promise you it gets better. Hang on. This is the boring stuff. Alright, so we have that high and presently this low. Okay? And why am I picking these levels? And you're probably asking. I'm not looking at the chat room in case you're asking. Reply in comments. Again, I'm going to have a section at the end, 15-20 minutes or so. I'll try to field anything you may ask. But I'm using this high here because, number one, this is the dominant price swing. We haven't really broken market structure to the upside in any significant fashion where this downswing is no longer to be considered. In other words, we're still lower. But we've made a swing low here. So we have a weekly low here, a low, and a higher weekly low here. So we have a swing low right there. So this is the current weekly range. Okay. If price were to trade up, okay, this is what you could do. Use the high down to the low. 62% retracement level is way up here. Okay. Sweet spot, and 79% retracement levels up here. Okay. Now these levels you would have noted on your chart. It will be a long time, if ever, that we get back to these points. Okay, but you still have to be cognizant of it, unless this swing breaks down, and then you have to do more measurements. But now watch what happens when we move down to these weeklies. Okay, you see this high here? See that high? Look what this is. And this is now we're gonna move into market structure. See this high, and this high, this low, and this low. Watch what happens. You see this high down to this low here, and then we bounced, and then we started to trade off again. This is the dominant price swing. I know that because, number one, the symmetry between the two smaller segments in price, between this high to this low. This is a replication of this move here done from this high down to here. Okay, and let me show you what that means by that. You take this high down to this low. Okay, see that? I'm going to take that same line without moving any distance of it, okay, and place it right here on this. This is the dominant price swing. Okay, we've yet to fulfill this down here, but it lines up right with that low. So if we start to lose ground in here, it's looking for this low here. But until that happens, this is the range that we're working with because we have a swing low in formation right now. Okay. So if we use that, this high down to this low, we could run a fib from that. Your 62% retracement level here, sweet spot, and 79% retracement level. So these levels you would have noted as well. Now that would look handsome if we were to rally up above this high here, then come back down and retest maybe this area for support. And that's where we talk about anticipating, okay? Seeing possible scenarios where price may do it. Doesn't mean it's going to have to happen like that, but just some ideas of what may happen, okay? So if we take out this high here, market structure would switch to bullish. We would look for opportunities to look for some support levels, and then obviously start looking for these levels to be upside objectives. Now, we've already noted this bounce in here. Let's look at what would unfold if we were using that level as our weekly range. Okay, and again, these are all means of looking for opportunities where price may reach for. Okay, when the market turns bullish, if it does turn bullish and breaks above these levels on the weekly, we could look for the 62% retracement level here, the 130.6, I'm sorry, 130.60 level, sweet spot, and then the 79% retracement level in here. Okay, that's the levels that we would look for upside if we were bullish. And then obviously, on a much more smaller scale, we could use this range here because this is a swing high with this swing low. Using that, and we're going to move that. We're going to use that as a means of segueing into the daily. Okay, so we've already did the monthly, we did the weekly, and obviously I didn't note the chart up, but you would have all these levels. If you look at the market review, the last two of them, I had these boxes drawn on our USDX chart, and I showed you how I arrived at that, and I'm showing you basically how I did it there and how I do it in the future, so you can continuously do it on your end in your own analysis, and it gives you some some framework as to where price may be reaching for. All right, here's the daily. Okay, and we're just basically using that same price structure, okay, that we found on the weekly in here. Now, we've had this nice retracement and we've sprung up in here. Okay, and then we retraced again. We're finding higher lows. The sweet spot is up here at the 125.41 level. The 62% retracement level comes in at around 124.80. Okay, and then if price does that, obviously it would be contending with this old high back here at the 127.50 level. Okay, that's again assuming it's a bullish market structure. Now let's change camps for a moment. Let's assume that we are bearish. Okay, we think that this was just merely a bounce or a retracement into this higher time frame price structure. We could look for, obviously this is the OTE for upside. Okay, look what we do when we have our fib extensions. We have the 162 lining up with the 125.65 and the 127 extension just a few pips above what we saw, and with the OTE pulled down from that high down here at the 124.90 level. So we got about 10 pip convergence with these two levels. So if we do have upside, be paying very close attention to the 124.80, 124.90 level. And then if we saw some weakness at that point, we could probably see some kind of a short-term high to price into the marketplace. But that's the monthly, the weekly, and the daily range concept, where you see where prices came from, where it's heading, using old support and resistance levels. In addition to this concept, and again, I'm not adding that here because it could be very long-winded, but I've given you the places to go to get that information. It's the Trading the Key support and resistance level video module, and this obviously just follow my weekly reviews, and you see how I use these levels. I pull them out and show them to you in advance, and you end up with something like this. This is what we share in our market reviews, and these are all boxes that I had in advance. And before the price ran up like this, I was telling you in a market review that we were in optimal trade entry down here and expect a bounce, which would be bearish for foreign currencies, and then foreign currencies would price in some kind of short-term high, and you saw that unfold. Okay, and then we saw this price action trade right back up to this level here, okay, which this box was in advance before price actually traded back up to that point. Much like if you go back to an older market review, I had a box prior to this price high here. Okay, and just go and look at the videos, guys. It's not cherry picking hindsight stuff. It's this is real things that I do, and how I'm able to call the markets like I'm doing in videos, and I'm talking in the chat rooms where I'm suggesting price may go. I'm not always right, but I'm, again, not to toot my own horn, I'm a lot more right than I am wrong, and it's very impressive when you see how precise these concepts will point to specific highs and lows in the marketplace. Now, again, obviously, before the dollar rallied up in here, if you're asking, why isn't there a box? I took it off because I was sharing a chart with a follower on our thread, and I wanted to draw more attention to this one up here. But let me show you why. I was talking in the market review that it was going to bounce there. Okay, here's the 79% retracement level, sweet spot, 62% retracement level. So here's an area where you would be looking for price patterns for bullish opportunities. Okay, so we're trading. Okay, we're trading. This is a 15-minute chart, and I'm a little ahead of myself here, but we're trading this range from this high to this low. Okay, so we're pulling back into 0.75% retracement, looking for an optimal trade entry, and then it unfolds. Now, I don't trade the dollar, obviously. I use it as a barometer for my trading in the foreign currency market. So if this is bullish, it's going to translate into sell signals in the euro and cable. Okay, and that you saw that unfold also. Now, since we're already on here, and I want to make good use of what I have on the chart now, and I have to come back to it later. This is the range from here, this low, up to this high. Now, remember I said earlier in our notes that we want to use support and resistance levels. Well, this is an old high. Okay, it's a key level, 82.80 institutional level. Okay, so that would be the new range. When price was trading back down, what would you reasonably expect, and how would you anticipate something to trade off of with that insight? Well, if you take the fib, pull from that low up to that high, here's your optimal trade entry area that you would hunt, buy signals in the dollar, which again would translate into sell signals for your foreign currency markets. And that's the reason why I said that we would probably see a Judas rally up and then sell off going into London Open in the most recent market review, and you saw that unfold on Friday. Alright, so we're not going to come back to the dollar. I did want to use it as an example of showing you how I use it in my market reviews and how it's beneficial, and you should be using it. Before I change gears, this range from this high down to this low, okay, price had pulled back up into what you might expect, optimal trade entry, and we've already seen it pull away from there. So it's interesting to see what happens this week when we start trading, and see what happens. I think we're probably going to see another reach below here, and you can figure out what that means for your trading, but that's what I anticipate. It doesn't mean it's going to actually unfold. Alright, so let's go down to a hourly chart. Alright, now we're going to start blending in the Asian range and support and resistance levels and the concept of dealing ranges. Okay, we looked at the dealing range between the monthly high and lows, the weekly high and lows, the daily. I jumped over to 4 hour because basically 4 hours is going to be basically the same thing you do here in an hourly chart. Alright, real quick, let's look at, this is a week. This is last week. Okay, these vertical lines here delineate Sunday. Here's Monday's trading, Tuesday. Okay, remember I was telling you Tuesday usually makes the high of the week or low of the week, generally at London Open. This candle here, that is 700 GMT. That is the very like I said, it's like 60 minutes into what I call my London Open kill zone. And then that was the very high of the day, and then it's also the high of the week. Friday we just got short of making another run to that high on Tuesday, but overall the money was made on the downside, even though we did had some nice pops up. And excuse me here real quick, let me grab a drink, I'm getting parched, excuse me. Thank you. All right. These levels here, also, we've noted these as well for a while now. Check out the market reviews. They're not put on here for this presentation. We've talked about these. The 123.60 level and the 123.80 level. 80 level is institutional level. I like to watch, teach that as a real influential market level. It's psychological. A lot of dealings go around the 80s, the 20s, the 50s, and the full figures. And obviously the mid-figure 50 level is one to look at. Even though we traded down with a level of 123.60, the chart says 123.59. I don't know what happens. It always moves a pip or two away when I change time zones, but not time zones, time frames. But let's look at how we can break this week down and how you should do this going in the future and start practicing some of these concepts. Okay, we had, this was Friday's range here from the previous week. In other words, 2 Fridays ago. This was a nice range in here. Okay, price ran up. Okay, and Sunday into Monday we retraced. Here is the 62% retracement level. Here's a sweet spot, and here's the 79% retracement level. Okay, so it entered into optimal trade entry, and then rallied up again. Okay. If you look here, the same concept I'm sharing with you, it's ranging. Okay, this is the new range here. This low up to this high. See this? See this short term swing high here? All I need is 3 bars, and then price starts to retrace back. Okay, and again, we're using an hourly chart, so you don't have to be sitting in front of the chart every 5 seconds. Okay, it allows you some time to react. Okay, to what you're seeing unfold in the chart. In other words, you're not looking at a 5-minute chart saying, wow, look at this, it's already happening. You can't do nothing with that. It's already starting to move. These are hourly candles. Okay, so now if we use this range here, this low up to this high, this is the Asian range. Okay, this is the Asian range. By plotting your fib on that range from low to high, same premise. $79, $62, it entered into the sweet spot here. And I realized the live stream is probably not the best format for this, and that's why I was a little disturbed when I found I couldn't use the application I was going to be able to share this with you. It would have been in a high definition, but you know, you just have to bear with me. I apologize. But this low here actually forms at 6 GMT, which is the beginning of my London open kill zone. And then you saw the low form here, where we have a very nice doji. Actually, I don't want to do that. Okay, here's a very nice doji. Okay, and then we have a higher low here. Okay, so now we have a very handsome opportunity to get long, because we have a low here. See how we have a low, a lower low, now we have a higher low. Okay, we formed, in terms of market structure, a swing point. So now we can look for retracements back to get long. Okay, so now watch what happens here. As price starts to run up, okay, after it starts rallying up, you see this high and the low formed on that Friday prior. Okay, can you see how that was the dominant price swing? This is what you would have saw. Okay, can you see how that's the dominant price swing? So that would be your new range. Okay, you would look at the ranges here. So as price starts to turn the corner here, you could look for a sell signal, because we're trading at a key level. Okay, turtle soup, which is a false break above an old high, sell off. Okay, when it starts to sell off, where should you reasonably expect to see price trade down to? If you pull your fib up using the range concept that we're talking about, okay, here is the 79, the sweet spot, and the 62% retracement level, this area right here. Right in here. This is where you would reasonably expect to see price when it trades off here to go to. Alright, now I'm going to come back to this in a second, how we can use the concepts for the short side. But overall, this is how you would see price, learn to anticipate rather, where price may be reaching for. Okay, and all we're focusing on is just using a simple Fibonacci application and then looking at range highs and lows. Okay, and I get a question always, why do you use this high or why do you use that low? Why are you picking this one and why are you picking that one? I'm showing you how, by looking at all the time frames and going from the higher down to the smaller, okay, and then using key support resistance levels like we have here, how to blend that with time of day. Now these little orange lines in here, this is the Asian range. Okay, this is the Asian range. This is the Asian range low. This is the Asian range high. In other words, this is the highest high and this is the lowest low between Asia's open and midnight my time in New York. Okay, and that allows me to decipher where the dealers have established the initial high and low of the day. Okay, and then I look for a manipulation on their part to facilitate a trade, and I'm going to break that down now as we go. But let's look at real quick the high that formed here. Okay, we're going to go back to Tuesday and we'll move from Tuesday out. Okay, so here's Sunday into Monday. Here's that retracement rally up. Here's the Asian range, okay, on Tuesday. Now at this time your chart would look like this. Okay, here's your chart. Here is a key level of resistance we would anticipate, and here's an old high. By itself, that is an area to be noting for possible stops. Okay. Now if you see this scenario like that, you could expect price to make a run up. Now if you haven't seen my Judas swing video, this is like one of the coolest things there is in terms of smart money action, because it's very consistent. It happens like 2 or 3 times a week. It's something you can anticipate. It's very clear. It's very easy to see. It's not ambiguous. It's very, very, very clear. And I'm going to give you examples of it here. This high here, if we see a Judas rally up out of the Asian range going into London Open as the initial move out of the Asian range, in other words, see how it stops? The orange lines don't continue on. They stop at midnight. That's the only segment of market action I'm concerned with. Okay, because the banks are establishing, okay, a base of orders. Now, I don't have a book in front of me. I don't have access to what the dealers have. But I can see it on the charts when they leave the footprint of what they're actually doing. When they set up a snare and a trap to get traders on the wrong side of the market, I know what they're going to do before they do it. And when I see that footprint they leave on it, then I go and I do my trading. We would expect the price to run up above this old high into this resistance level, 123.80. That's an institutional level I teach to watch on all pairs. Okay, every pair there is. If you note on your charts the full figures or 100 levels, the 50 levels, the 80s, and the 20s, those levels by themselves are very, very dynamic support and resistance levels. But when you add to an old high like we have here, and then back here, see these old highs back here? That's a expected level of resistance. Folks that have orders that are resting above that in the form of buy stops, because now think about it, prices slid down. Somewhere in the world, some Joe is short here. Okay? So the banks are going to run that up there, take them out, because they don't want them profiting on a position they know that they're going to be wanting to establish themselves. Okay, so the banks are dealing and establishing a net short position in here. Now, I would expect or anticipate that unfolding if I see the Judas rally, which is what this is here. The initial move out of the Asian range is generally the wrong side of the marketplace. Okay, put that in your notes if you're first time watching my material here. The first couple hours of trading in London, generally, is the first move of the day is usually the counter trend of the actual day's trend. In other words, if it moves initially up, it's usually going to be a down day. Okay, and if it moves initially down, it's going to be an up day. And I know it sounds strange, but it is what it is. But it's essentially the banks pricing in a rally or sucker play. Okay, they engineer a rally to go back to a previous area of stops. This is what that is right here, at a key level. Okay, at an old high, taking out where stops would be resting. So now they gun those stops. Now what's happened? You've essentially taken out the bears that were right initially here. Okay, also triggered in folks that think this is a bull flag. Okay, but they want to be safe, they think, by having their buy stop to enter a long position right above this candle. So they'll run it up there, take out the orders that are net short, their buy stops, generate new longs on buy stops for folks that want to be buying and getting net long. So both market participants on the retail side and sometimes many times on the institutional side are out of the market. But the dealers at the bank level, okay, are established a net short position. They've taken out the buy stops by taking the other side of the trade. Okay, so in other words, they're going to sell to them to have the buy stops with the intent of eventually repricing move going lower and then thus profiting in the marketplace. Now, this level in here, okay, you see that same thing happening. Okay, we have the Asian range here. Tuesday, we already priced in a high. So now the rest of the week, we want to be looking for the Asian range consolidation like we have here. Okay, we already had the hand tipped to us. We suspect that the banks are now going to price in a Judas rally going into London Open. That means they're going to send it up first, the sucker play, to get everybody thinking it's going to go higher. Okay, and then they put the brakes on. Well, this is an hourly chart. Okay, so you see here's the run up. Here's a nice hammer, or some of you folks call them pin bars. Okay, but here's your turning point. You have a lower high here, a lower high here, and here's your high. This candle, okay, this candle here is 8 GMT. Okay, this is 8 GMT. That's 3 o'clock my time. That's like the beginning of London. That's the beginning of the show. This one here is 6 GMT. If you look at my London Open kill zone, that's the very beginning minimum hour to start looking for the London Open setup. Okay, so you got 6, 7, 8, 9, and 10 is the last hour for that pocket of time. The higher low of the day will form between 6 and 10 GMT, and you have my word on that. Okay, just look at it on average. You're going to see that it's about 75% likelihood that the higher low of the day is going to form in that window. Now, if you just had that small segment of time to look at, and you have some basic understandings of where stop losses would be resting, the initial move being the fake out. In other words, we're building this premise of daily bias. So if you haven't been keeping track of what I'm sharing with you, I'm showing you how to develop a daily bias. So you only focus on one type of thing, and you don't go in there thinking, should I buy today or sell today? I don't think like that. I know what I'm trying to do that day. If it doesn't unfold like I want, I just turn the charts off and go to bed. Okay? So there it is. But Tuesday, again, we're looking for the higher low to form for the week, and obviously, we see the high form here. We traded back down. We went into an Asian range consolidation. We would anticipate an initial rally up. Okay, up. Now, prior to the Asian range, where is the swing high that where stops would be resting? See this right here? We have a lower high here, a lower high here. Stop losses for those that are short, they'd be trailing stop loss, and they're going to put it right there. Okay, right there is where the stop loss orders would be. If you take your line, draw that out. Is there any coincidence there? See any coincidence? They took it right up there, took out the stops, and then repriced. Okay, and I know some folks out there can't get it through their heads that the market's that manipulated, but it is. Okay, and if you understand how the game works, it's crummy that it happens to certain people and probably some very good people, but unfortunately that's just the way it is. That's the law of the jungle. Okay, now we had 1 day down, 2 days down. Now here's what's going to happen. Folks are going to say, well, the market's going down. Okay, we would anticipate a Judas rally out of this if we're a bear. Okay, but watch what happens. If we see the Asian range and it drops out of it initially and blows out what? An old low. What has happened? They sucked folks into the market thinking, okay, well, I want to be a seller if it takes out this low here. Okay, or the folks that went long here on this doji, okay, and then rallies up and just going into Asia, their stops are going to rest right below that low. Well, we would have had no sell signal generated if we're continuing from the Tuesday's high. Okay, but let's drill out again because I'm zoomed in a little too tight. Remember where we are in terms of the range. Okay, if you're, I just gave you an example. What happens to a lot of you folks? You're so zoomed in, you forget where you are in terms of navigation. This old high on Tuesday and the previous Friday is the dynamic swing up. Now we're retracing. Okay, that level is this low to high. Your optimal trade entry realm is right here. Okay, so we're in that. Now we Judas down out of the Asian range in here. This level is the 90 level. Okay, and again, if you don't know anything about the Fibonacci tool and how I use it, I use that level 90 as my last ditch barrier for a swing. In other words, if it violates 90, I'm probably wrong and it ain't going to go anywhere. But you'll see many times that the 90 level stops anything that beyond the 79% retracement level. I don't use it as an entry. I just use it as a buffer for qualifying trade setups. But this right here, okay, if you look at cable and fiber and dollar, you'll get a divergence here. Okay, and I'm not going to go there because I don't want to load up the charts at Daily FX because it's number one, it's going to take too much of my resources. I'm teaching on a laptop and it's already screaming and smoking as it is. So this right here, okay, the initial move is down out of the Asian range. You wait for the swing low to form. Here's a low, a lower low, a higher low. There's your swing point after the stops have been taken out here, after we've moved down into a retracement level of the most dominant price swing up. Okay, and then we would expect to see price to rally up. Now, again, the same question is where would we reasonably expect price to go to? Okay, where would we reasonably expect price to go to? If it's going to go up, where's it going to go? Well, since we turned the corner here and we started running above, this high, now with this low, is the range that price is retracing into. So you pull your fib, okay, here is your 62, sweet spot, and 79% retracement level lays right one pip below this resistance level I had at 123.60, and the line sitting at 123.59 now. So this is a level that we would reasonably expect to see price trade back to. Okay, and again, here's that 90 level, and it staved off price right to the pip. Okay, and again, the 100 level is up here, and then that old resistance level at 123.80. Okay, so price retraced back down into the Asian range consolidation, going into Friday's trading. Okay, now same scenario we had on Tuesday, we have here. Tuesday's high still in effect. Asian range consolidation, old high, here's where the stops would be, and with this old resistance level, so we have an area of concern for a stop raid. If we have the initial move out of Asia's range in London, that rallies up, that's going to be a Judas swing to take out the stops, the manipulation, and then reject it, send it lower, and there we go. And that's what you had here on the fiber on Friday. Okay, so what we've established here, number one, is that if we use the range from the higher time frame down, okay, we can look for directional premise. Okay, and if you just focus on that directional premise from the monthly, weekly, and the daily, and just use those trade setups, you're not going to get a trade every single day, but you will get trades that pay out really well. If you use the daily and 1 hour with key support resistance levels, and then the Asian range, okay, with time of day studies like that we have here, the London Open, you can nail down very handsome price swings. And let's look at these here. Okay, in other words, if we got in here on this Judas up, we're not even going to get the high as a high. We're just going to use the body's high here. There's 60 pips. If you held it into the following day, it's 112 pips. And if you held into the initial move and on Thursday's Judas, it's 121 pips. Okay, and that's a short-term swing trade. Now, this past week, you know, it's kind of muddy. It really wasn't an ideal week. Usually, I'd like to see weeks that have like a 300 pip range. That's a really good range, but you can still build wealth on 50 pips a week. And I'd say this every time I get an opportunity to talk about it. My actual weekly objective is anywhere between 50 to 75 pips. That's my expectation. and it blows people away that that's the level of pips I anticipate making. Many times I do 3, 4, 5 times that. Okay, and I can usually do it, 2 or 3 times over that in one trade. And by having that very low expectation in my trading, it frees me up to not have to be chasing the market. I don't have to worry about being in there every single day. I understand the general, generic things that take place in this market. And your keys of this webinar should be: number one, there's no reason for you to rush. Two, there is a means of manipulation that goes on in the marketplace. And yes, you have to respect it, but no, you shouldn't fear it. There is a real place for you to enter. There's a timing aspect in the marketplace. It's very generic. It's London Open. It gives you the higher low of the day. And if you want to know how to trade, and you can't trade the London Open, but you can trade New York, check out my New York trading session video. It's about an hour and a half, or maybe an hour and 45 minutes. It really goes into some of the things we talked about here. But once you've established the higher low of the day based in London, how can you trade the New York Open in sync with that and not have the trends of the days bias against you? So in other words, you could be able to trade after the fact in here and catch a little piece of this move in here. So this initial rally up also, when you see that, okay, and it starts to trade back down, okay, you can use optimal trade entries on the 5-minute chart, which we're not going to do here. But they would give you opportunities to get short as well. So checking my notes and see where I am and make sure I covered everything I intended to. Yeah, okay, let's go back out to a daily chart for a second. All right. When you have your daily charts up, okay, one of the main things that you should have always noted on your daily is every time you make a swing high or swing low on a daily, okay, you want to be able to see where they lay out. And I'm only using this tool again just so you can see. Okay, we have a swing high here, swing low here, swing high here, swing low here. That's lower than this one. We have a swing high that's low. It's higher than this one. So now market structure is bullish here. Okay, because we've broken an old swing high. We came back down, made a higher swing low than we did here. So now what is this? This low here is a long-term or intermediate-term swing low. Okay, so that means anytime you get a swing low on the other side of this one, okay, it's going to be a short-term or intermediate-term low, and then making that a long-term low. This is market structure, okay? Everybody hears me talk about what is market structure, what is this? It's really simply a concept that I adopted from Larry Williams, and I'm not a fan of Elliott Wave. I think it's crap. I think it's so, it's left to subjective thinking, okay, and you really can't come away with what wave is what. That's just my way of viewing it. It's very subjective. Market structure is very generic. Okay, you just got to look at where the swing highs and lows are, and if one's broken, you know it's bullish. If this is broken, you know it's bearish. Okay, we've been breaking highs, okay, and all the lows have been maintained. Okay, so we have a short-term swing high here, and we have a short-term swing low here. Those are the 2 points that I would be referencing right in here with a bullish bias for right now, just a very modest bullish bias. But if we give up this swing low here, then obviously I think we're going to trade lower, at least reaching for this one, because that would be the most recent swing low once this is broken. Okay, so I covered market structure in a generic form. I go over a great detail in the trading plan development series. I probably will bore you to death with it if I haven't already put you to sleep now. The concept of market flow, I use that as well to help amplify some of the concepts. But really, if you just focus on where we are in terms of swings on the daily chart by itself, just that alone, okay, and let's zoom in. I'll show you what I mean by that, and we'll close this section, and we'll open up for a question and answer. This swing low, okay, this swing low here, the very next day, once this candle closes and this one opens up, you're going to be looking for a down move initially and get long. And you see that after the fact in the form of this candle having a wick In other words, it opened here, traded down, made that wick, and then went up. That's the Judas. That little segment of area of price is exactly where the central banks do their work. Okay. Same thing here. We have the candle. This is a Sunday. So you have this candle, and then blend these two candles to give you Sunday, Monday's action. We have a lower candle here. Okay. This price action in here was the initial rally up and then down. Okay, but then close up. There's something in here you could have traded and made some money on. This candle here is still below this one, so the bias is still looking for sells. Just using swing points alone on the daily chart. If you guys are looking for daily bias to trade with, what I'm showing you right now is worth gold. Okay, forget everything you saw in the books. Forget everything else that you want to learn. Okay, just focus on just this for 1 month. I promise you. If you do this in a demo account, you will absolutely blow away the majority of what you learn in paid courses, mentorships, all that business. Okay, I'm telling you, this is exactly what the banks do. The banks focus more on this chart than any other form of time frame. It's the daily. Okay, swing high here, looking for initial move up on this candle with a Judas rally, run out the previous day's high, sell off. Okay. Here's a swing high. Here's a swing low. Even this little range here, you could have gotten paid on this one. Okay, all you're doing is looking for swing points on the daily chart the very next day, trading in that direction. Here you have here, swing low. This candle solidifies this as a low. Again, this being, I think it might be a Sunday. But still the same thing here. Same thing, we run up to an old resistance level after initial move down. Okay, that was your small little Judas in here. And you really see this by studying price action on an hourly chart and a 15-minute chart, looking at a weekly range on a day-by-day basis. Okay, and then just studying it, using the things we talked about here, some of the things that you'll see me teaching in the trading plan development series, and obviously everything that's in the Baby Pips thread, what every new and or aspiring forex trader still wants to know. All that video library based on what's shared here, and all that information will give you absolutely a mind-numbing approach to trading. And if you just spend some time with it, okay, I know it takes a lot of work and it's a lot of material, but I guarantee you, if you do the work that's necessary, in 3 months of just practicing on a demo account, you'll be convinced that there is a real method behind how the price action is behaving, why it's behaving, and you'll be able to anticipate it. You won't trade every single day. Okay, and that's okay. You'll be able to limit your trading to Tuesday, Wednesday, and Thursday. Try to avoid trading Fridays and Mondays and Sundays, and just looking for the higher low of the week on Wednesdays, and trading that weekly direction using these ranging concepts that we shared here, and wait for retracements and pullbacks and key support and resistance levels, swing points, time of day, London Open, initial move is a fake or raid, blending all those things together. I absolutely guarantee you will see results that will blow your mind. Okay, and we have some folks that just this year have stepped into a realm of consistency and pip hauls that I get tickled to death by, and that's really why I'm doing it. I don't make any money off of this. I spend a lot of money and a lot of time doing it for free because it's a hobby of mine. But I really get jacked up when I see folks sharing their enthusiasm and their success, and when they see that little light bulb go off and that aha moment, that's the moment I'm addicted to, that moment of astonishment. So I encourage you to spend some time with the concepts and share with me, like I've shared with you, how it's done for you. And again, I appreciate all the interest you guys have shown and the support of the thread and really making me feel welcome at Baby Pips. I think it's a wonderful website, and I'm honored that they think as highly as they do of me to have that thread sticky like they did on Newbie Island. But yeah, I'm going to close this section here, and I'm going to open up for question and answer. I want to kind of limit it to like 15 minutes or so, but if you have anything that we can't answer here, obviously it's very important that you share it with the thread, because many times you guys are asking a lot of the same questions, and if I can answer it in a video and knock out like 20 or 30 people that are asking the same thing, that's usually what I do. But if it's like one or two, I usually have like a 3 or 4 lag in time of days before I actually get to your emails, because I get a lot of them, and I want to give you the response that I think is necessary or respectful. But many times there's a lot of answers I can just direct you to a video or to the thread, and many questions really, you may feel silly asking, but they're not silly. You want to learn, and I want you to see you do well with it. But you don't always have to have me answering the questions, because there's a lot of them that are very fundamental to the things I've taught. And don't be afraid to take some answers from folks in the thread. I read it. If I see someone steering someone the wrong direction, I'll step in and respond accordingly. But generally, you'll find that majority of what folks are responding to you in the thread, it's in line with what I either taught or feel about the subject. Okay, so let's open up for some questions and comments and see what you guys have. Okay, lazy. The question is do I look for ever an optimal trade entry? I'm assuming inside the Asian range. Is that what your question is? Inside of it before the Judas actually forms? Okay. I do usually. It requires a very large Asian range. In other words, if the Asian range more than 40 pips, I would look for a optimal trade entry within the Asian range, because many times um, the move will happen inside the Asian range itself. In other words, it won't see a Judas outside of the midnight time frame. So if you have in other words, the easiest way to answer that would be if you have a Asian range greater than 40 pips, okay, expect an optimal trade entry and or a reflection pattern to occur inside of the Asian range. Okay, and if that happens, number one, I'm generally not awake to trade it, but those are the days that I'll leave London alone and come back into the market around New York Open. Okay, so the bottom line is just hopefully you see a 40 pip or less Asian range, and if you get that, you're good. No parts of the trading plan series have been uploaded. No, they have not been. And I'm looking at the first week of September. When it comes to trading the news, and you'll find that London Open usually has a lot of news events with the fiber and cable. The long and short of it is I don't really care too much about what the news is if it's not at least a medium impact. So low impact I could care less about. Medium and high impact I do, but I also don't fear it, because number one, I anticipate the fact that the news event is going to provide me the Judas. It's going to be that raid or that manipulation on the parts of the dealers to push markets to take the stops out, and then my trade will usually unfold like I expected it to. So the news really is just like fuel to the fire that I already see burning. One pip breaks it. That's all it takes. One pip. If market structure is broken by one pip, it's over. 18 months. It took 18 months for me to get to the point where I felt comfortable that I was going to be able to do well. Hat trick. I usually try to watch London Open every day. The barriers to me not being able to see it would be either illness or because I am naturally an insomniac. I usually don't sleep well anyway. The London Open is my that's my killing ground. I stalk that more than anything else. And if I can do one or two trades, in the week, in that I'm good. But if I make the trade early in the week and I fulfill what my goal is for the week and I've closed out shop and I'm not having any positions, remaining, I'll just won't I won't worry about checking London because I've already fulfilled my goal. He took his profits at the old high, like I was talking. Honestly, I had to tell him to do it. He was going to be reaching for a little bit higher targets. I just told him to take 5 pips above, and he did. What is sample size in the context of forex trading? What do you mean by that specifically? I mean, is there? The Pro Traders Club I'm going to be doing on a daily basis. Really, I should be fair to say, number one, I'm going to do the weekly analysis. That'll be the million dollar Traders Guild weekly reviews, and I'm going to have a lot of macro analysis on that one. And on the daily Pro Traders Club videos, I'm going to have, when applicable, revisits to that information that we talk about on a weekly basis, but not as in depth. Um, but I'm going to cover on a daily basis the dollar and the yield information, the bonds, and how that all ties together with the commodity markets to give you, overall, panoramic view of the markets itself, not just specifically the FX. What charts do I have open in front of me when I'm trading? Like what time frames? Well, on my trading desk, I have actually 12 monitors. You can't see the other two in that snapshot I have, but it's actually 12 monitors, and I have a lot of the commodity markets. I have the indice markets like the S&P markets and such, and I'm watching the overseas markets like Japan, and I really only have like an hourly, daily, 15-minute and 5-minute chart up on the two pairs I'm trading, and I had the same thing with the dollar, and that's really basically what I'm looking at. I'm not looking at like 15 different charts every day when I'm sitting in front of the screens because number one, I have attention deficit, and I can't focus that much. So I have all those other charts up there, but I'm not always referring to it. Now I do refer to it when I'm doing my macro analysis, but I just generally don't have. I watch all those markets because everything is intertwined. The bond market is a very influential market, and obviously I want to measure risk. So I watch the equity markets through the S&P and Dow futures. I watch the CRB index, and I watch a lot of the commodity futures markets. And you can see, I don't really watch any specific stocks, no, but I watch everything in terms of, well, just think of it like this: if I'm bullish on FX, I'm essentially going to be bearish on the dollar, and the yields should be, going up, and bonds should be going down. So I want to see that thing happening across the markets, not just in one specific thing I'm actually trading, like the cable or fiber. I want to see the supporting evidence in other markets. right now it's kind of like a transitional point in the marketplace where it could be bullish or bearish, and that's why I've really scaled back my level of trading and really focusing on one or two setups. Really trying to do my best to do one. But it happens seasonally, and usually it's right about this time, and it also happens around Christmas time, and right around before Easter too. It is a decoupling between the market symmetry where the dollar and the bonds will behave a little bit differently. But you just got to wait a little bit, and they get right back in sync again. Bernie, I'm still trying to figure out what exactly the sample sizes you're asking for. Like sample size of like trade examples to build faith on something, or what is it specifically you're asking sample size of? First, second week of September, yeah, it starts. Fund managers really start coming back to work aggressively with September's first or second week because they got to get money put to work, and that's how that game works. It's window dressing. Every 3 months they really start putting it to work, but usually the summer months, it's slow. I subscribe to eSignal, and that's where I get all my feeds for everything. If you're seeing my charts, you're really only just seeing MT4, and occasionally, very very rarely, will I share charts from GFT's deal book. But that's simply because I'm accessing it with a really small, tiny little account that I've let my son play with. But my other charts, I don't ever share that with because for me to connect to the internet, I just don't trust. I just don't trust it. I mean, I've been attacked, through the internet a couple times, even through Baby Pip. So yeah, my children are about ready to go back to school. Okay, I think I understand what you're asking now, Bernie. Like, what's the sample size that I think is needed for a pattern to be back tested on? Is that what you're asking? Okay. Um, I'm going to use the adage I learned from Larry Williams in terms of sample size because he's a systems developer too. He does a lot of plug-in and system generated patterns. I rather look at the chart and see it and anticipate it and trade it. I don't care what they have out there. I think my objective analysis would be far superior to anything they got out there electronic, unless we're talking about the dealing of the banks themselves, obviously. But if you walk out of your house and you turn right and you walk down 3 blocks and there's a blue house with a white picket fence and there's a pit bull in there and you walk by and it reaches over the fence and grabs a hold of you and shakes your arm loose, okay, and tears a whole chunk out of your right arm, okay, how many times are you going to take that same walk before you realize when you get to that blue house with that white picket fence there's a dog that wants to eat you there? Well, that to me is translated in very generic terms in the marketplace. I seen enough evidence, and it'll be subjective to everyone else in different levels. In other words, I've seen that the optimal trade entry works just by looking at a few months of information on it. I've learned that the London Open kill zone strategies and the patterns that I trade with worked just by studying a certain number of months with it. Um, there was a time when I felt the need to go back and justify my own second guessing of it because when I started talking about it with other folks in America Online, they were asking the same questions. Show me sample sizes. And at the time, I felt the need to always try to prove everything. And I've matured to the point as a trader where, and even as a mentor, I don't. It's not my interest to drive it so hard that you have to believe it because I gave you information. It's more believable for you to go into the charts like I did and you show yourself this information. You determine what sample size that you need as a trader to trust this information. And that's why I'm telling you, spend some time in a demo account. But I promise you, if you do everything we've talked about here and everything that's talked about in those videos, in 3 months' time, you will have established the necessary foundation to be on your way to consistency. Now, I'm not saying risk real money because I can't by law. I'm not a CTA, and I'm not telling you specifically what to do with your money, but I am telling you to practice in a demo account. I'm safe by saying that, and you're protected as well because you're going to make mistakes. But when you start seeing these patterns that repeat over and over and over again, you'll realize that sample size really isn't that big of a deal if you know specifically what you're looking for and what time of day, because it happens several times a week. It ain't going to happen every single day, but I guarantee you there's going to be a trade set up on a Tuesday, Wednesday, or Thursday of every single week of every single year. I guarantee you that. Using what I'm teaching, and if you just find just one of them, it's it. It's all you need for the week. There's some times where I get aggravated with trading because of outside influences. It's not that trading itself that I got tired of. It's just I'm trying to make a trade because I want to make a trade, and I feel pressure from my family life. My sons are struggling in a school, or they failed at something, and it's the dad or husband influence that takes place. So it's the human aspect of the trader. It's not the trading. I love trading. I'm very passionate about trading. Um, I don't ever see me really stopping until I get 20 million. 20 million and I'm out. I'm done. And until then, you guys got me as a participating mentor in sharing. So hopefully that answers your question. There is a pattern in that, yes, and it's a very influential in price action. Yes, the question was, can you use 10-year Treasury price and 10-year bond divergence? Yes. I do see me scaling back the level and intensity that I do in mentoring when I get to that number. Yes, um, but I do like sharing. But there's some projects I would like to do if I get to that point where maybe like a couple times a year I would do something. But as a steady diet of every day or every week, yeah, I'll be honest with you, I don't see myself doing that. I wouldn't say 5 years. Is a little less than that. I would absolutely love to meet you guys face to face, and maybe do some live trading. You guys can see me trade a $1 million account. And what's that feel like, and watching it and seeing it, and I think that that'd be cool. Well, you guys got time between now and then to build yourselves up. Now, obviously, I'm going to maintain the email address I have because I still want to get some feedback from you folks, because I'm sure years from now, as long as Baby Pip is still in operation, my thread will hopefully meet someone, and they'll do something with it magical. And I'm really really excited about the stories that you guys are going to have with me. I've had a few folks share with me some of their successes, and number one, I appreciate their willingness to do it, and I understand many of you really just want to make money, but I've always asked just if you would just be so kind to show me, what you're doing with it. And it don't have to be right away. I mean, it could be, years from now. I'm still going to have that email address, and I would still absolutely love it. Um, I got a really good collection of emails this week from folks that have done real well, even in this really ugly market condition that we've had recently. And they've done really well, actually a lot better than I did as the markets have traded for the last couple of weeks, and I'm very impressed by it. And it's just using the stuff that's in the thread. Well, I have a question for you guys. Obviously a lot of the stuff that we talked about here, the regulars have seen before. But has anyone in here learned anything here today? The folks that emailed me, are they registered in? Is that what you're asking? Good. Yes, 90% of the folks that are actually emailing me are all through Baby Pips. Yes. I counted the last month's emails, just last month, okay? And we're talking about the month of July, so we haven't even factored in what we've done for August. I had 822 emails just the month of July. So I apologize if I don't get to your emails right away. I'm not ignoring you. I just can't find the time to get through them all. And a lot of them are questions that are easily answered if they just continue to read through the thread or watch some of the videos. But no, no one's asking for any money. But it is a lot of feedback. And while I kind of more or less invited that thing, you'll notice that I don't have my email address in the most recent videos, but I do make it accessible to folks on the thread. So I kind of really hoping that folks would just send me some feedback, and if they're really struggling with something, just give me a hint. Say, hey, look, next time in your videos, can you talk about this? And if you have real long-winded emails, they're better suited posting in the thread because it's probably like multiple layers of question answering that would be needed, and you probably would be sufficient answered by someone else, or I could then obviously have that as a record for folks that are asking similar questions. Yeah, it's the ranges. Well, let's do this before we close out real quick. Let's show this. All right, you see this level down here? Okay, this is 107.60. Okay, um, that is an old level of support resistance. If you go back in time, you see all that right here, all of it in here, all of it in here, here. Okay, and we saw price rally up. The same ranging concept that we used here, okay, is why you see price action having done what it did here. Okay, because this is the range pullback here from this is the daily range. I'm sorry, the dealing range here and here. Okay, now from this same level here, when we ran up to here and price was trading back down. Again, this is a monthly chart. Here's the optimal trade entry sweet spot. I'm sorry, sweet spot. Here's 79% retracement level and 62% retracement level. It stopped dead to rights on the sweet spot here and rallied up, and it stopped dead to rights right on the 79% retracement level here and rallied up. Okay, that is a monthly chart, and it's huge amounts of money. And I'm telling you, it's fortunes. I mean, lots and lots and lots of money. Okay, using these concepts, and they don't set up a whole lot. But here's the point: when you see this setup, okay, and it starts to turn, you know you got days of opportunity to get longs in here, okay? Days. These are months. Each individual candle is a month. So if you start with that higher time frame macro view, and then use that to develop your bias, this is the only thing you're doing, okay? I think it was a couple months ago, I set up that approach towards teaching pip hangers some consistency by just looking for one thing. And I kind of more or less used the magician's force on him when we were setting up the parameters. I said to him, I said, "You're going to be a bear or bull?" And I was kind of driving him to be a bear. So if he would have said bull, I would have said bear. I would have made him say that. So anybody that's in magic, they'll know what I'm talking about with a magician's force. But I wanted him to be a bear because that's what the primary trends were established at the time. So if he was going into the market looking for only Judas rallies up with overbought conditions, he would be set up to be on the right side of the marketplace. Without having to go through what we've been doing here and for the last couple of weeks, I just wanted to make it very easy for this individual to be focused on one thing and not have to think too much about it. And that's really the core to being successful, is having very little to do and guess about and just doing the work. And hopefully, even though it doesn't take much time at all, you at least do the work on these higher time frame charts like this, and it'll give you everything you're looking for is found on that monthly, weekly, and daily. I'm telling you, if you just do the work on it, it's there. But I'm going to close the recording here, and I'll stay in the room for a couple more minutes, but I'm actually going to close the recording here.